Warren Buffett. The name alone says it all, right? Investment genius. But what if I told you that the real secret to his unbelievable success isn't some kind of magic touch? What if it's a formula, a method that we can actually break down and understand? Well, that's exactly what we're going to do today. We are unpacking the data to see what's really going on.
So this really gets to the heart of the debate, a question that's been bouncing around Wall Street and academia forever. Is he a true one-of-a-kind genius, or is he just incredibly lucky? You know, like the guy who flips a coin 1,000 times and somehow gets heads every single time.
Okay, so before we even try to solve this puzzle, we really need to get our heads around just how big his success is. I mean, this legend, it's not built on hype. It's built on cold, hard numbers. Let's dig in.
And this is pretty staggering. So the Sharpe ratio, right? That's just a fancy way of measuring how much bang you get for your buck, risk-wise. The higher, the better. And when you look at every single US stock that's been around for over 40 years, Berkshire Hathaway is at the very top. Number one, period.
And here it is, the number that's had researchers scratching their heads for decades, 0.79. Now, over the long haul, that is an excellent Sharpe ratio. It's almost double what the overall stock market gave you during that time. But here's the kicker. It's great, but it's not, superhuman. It doesn't scream magic. So how on earth did a performance that's just great, not legendary, make him one of the wealthiest people on the planet? That's the real mystery.
Well, that brings us to our first big clue, and it's a powerful one: leverage. See, to turn a great track record into a truly legendary one, you need an amplifier. You need a way to turn up the volume on your returns. Let's take a look at how he did it. So, some researchers did a deep dive into Berkshire's books, and what they found was that, on average, Buffett has been running the company with about 1.7 to 1 leverage. Now, what does that mean in plain English? It means for every dollar of his own, he was investing about $1.70. He was boosting his bets. So what exactly is leverage? Think of it like a megaphone for your money. When your investments do well, it makes those gains way, way bigger. But, and this is a huge but, it's a double-edged sword. If you're wrong, it magnifies your losses too. The fact that he's used it so successfully for decades, that in itself is just incredible.
Okay, but here's the thing. It's not just that he uses leverage. Lots of people do that. The real genius is how he gets it. I mean, anybody can go get a loan, but Buffett, he found a source of financing that's so cheap and stable, it's practically a superpower.
And this right here, this is a masterclass in structural genius. A huge piece of that financing, about 36% of his liabilities, comes from something called insurance float. So, you know how you pay your insurance premiums up front? Well, the insurance company gets to hold on to all that cash, your cash, and invest it for themselves before they ever have to pay out a claim. That pool of money is the float.
Now get ready for this, because this is the craziest part. The cost of that loan, it wasn't just cheap, it was better than free. On average, the cost of his float was 3% lower than the interest rate on super safe US Treasury bills. Let that sink in. He was literally being paid to hold and invest billions and billions of dollars.
All right, so he's got this massive, stable, and unbelievably cheap source of leverage. That's the rocket fuel. But what about the rocket itself? Where is he pointing all this money? Well, our second big clue is all about the kinds of stocks he buys with it.
You know, Buffett has never been shy about his strategy. He laid it out right here. It's simple, really. Whether it's socks or stocks, he wants quality stuff, but he wants to buy it when it's on sale. Sounds easy, right? But the data shows he has applied this idea with incredible, almost robotic consistency. And when the quants crunched the numbers on his portfolio, they found it was anything but random. His stock picks always seem to have 3 key things in common. They're safe, meaning they don't bounce around a lot. They're cheap, your classic value stocks, and they're high quality. We're talking profitable, stable companies with a solid track record.
So for the longest time, the standard models just couldn't make sense of it. Academics would plug in all the known factors, and they'd still be left with this huge, unexplained chunk of return. They called it alpha. And that alpha, well, that was the Buffett magic.
But here's where the story takes a turn, because recent research changed the game completely. When analysts went back and created new models that specifically accounted for those factors we just talked about, safe, cheap, and quality, something amazing happened. That magical alpha, poof, it pretty much vanished. It became statistically insignificant, which means the magic was a method all along.
What's wild is that his entire strategy lines up almost perfectly with two powerful investment factors that academics only really codified decades after he started doing it. The first is called betting against beta, which is just a fancy name for buying safe, low-risk stocks. The second is quality minus junk, buying great companies and avoiding the bad ones. Think about that. Warren Buffett was a factor investor before the term even existed.
And this leads to what I think is the most fascinating question of all. If his success really comes down to a consistent method, could you copy it? Could you get Buffett-like results without actually being Buffett?
So to find out, the researchers did just that. They built a simple, computer-driven portfolio. No genius required. It just automatically bought stocks that were safe, cheap, and high quality. And the results? They are absolutely astounding. This mechanical portfolio performed incredibly well, sometimes even better than Buffett's public picks. And check this out. Its moves correlated with Buffett's actual portfolio 73% of the time.
Let me put that another way. A simple, rules-based formula can explain more than half of what Buffett's public stock portfolio does month to month. So the big takeaway here isn't that he's a wizard who finds that one magic stock no one else can see. No, it's that he is unbelievably consistent at buying the right type of stock over and over again.
So if it's not magic, and if the formula is pretty clear, what does that mean for the legend of Warren Buffett? Well, I don't think it diminishes his accomplishments at all. In fact, I think it helps us zero in on what makes him truly, truly brilliant.
You know, maybe he gave us the answer himself in this quote right here. He's saying you don't have to do crazy, complicated things to get amazing results. His whole career is proof that the real power is in sticking to simple, powerful ideas.
So, when you put it all together, the real secret isn't just one thing. It's this incredible three-part combination. First, you've got the insight. He figured out these winning principles, safe, cheap, quality, decades before anyone else was talking about them. Second, the structural genius. He built this amazing insurance business to give him that cheap, stable leverage. And third, and this might be the most important part of all, the discipline. The iron will to stick to his strategy for over 50 years, even when everyone else thought he was crazy. And really, that leaves us with one final big question. The formula seems pretty clear, right? But knowing how to do something and actually doing it, especially for a lifetime, those are two totally different things. So the question for all of us isn't, do you get the strategy? It's, do you have the discipline to stick with it for the next 50 years?